Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services leader. You can find me on Twitter at XBorderTax. On this week's episode of Cross-Border Tax Talks, I'm excited to be joined by Nita Asher. Nita is a partner in PwC's Washington National Tax Services Group, specializing in international taxation. Before joining PwC, Nita was legislative counsel at the Joint Committee of Taxation from 2017 to 2019, when the Tax Cuts and Jobs Act was enacted. Nita, welcome back to the Cross-Border Tax Talks podcast.
Happy to be here, Doug.
Well, before we dive in to the potential Biden tax proposals and what that may mean for corporate America and other taxpayers, wanted to just take your temperature. It has been a crazy news cycle for the many weeks. And after the election, I decided that I wanted to take a little break from the amount of news that I was consuming. And I'm guessing many of our listeners had a similar experience. And so, frankly, I'd been kind of putting off a bunch of those series that many of our colleagues and friends have been recommending, and have frankly turned to that as my most recent guilty pleasure. I'll particularly make a shout out to the marvelous Mrs. Maisel that my wife and I have been enjoying immensely. But I know you've been trying to take a similar break from news, or at least maybe the amount that you've been consuming. I didn't realize that this was going to turn into like a self-help kind of podcast. But what have you been doing during the pandemic and the post-election, if anything, to relieve yourself of the stress of the news cycle?
Doug, I've tried many things, including Netflix, but I have recently found solace in contemporary fiction. One might even call it romance novels. Just something light to have in hand after a day of going through, technical tax updates and taking a break from the news. So that's where I am right now. I will give a shout out to Sonali Dev, who is a contemporary Indian American author, and for some light reading and something to help take a break from the news cycle.
Well, hopefully our listeners think you're always gonna learn something new on the Cross-Border Tax Talk. So that's a new author for my list. I like the way you described it as contemporary fiction. If that is the case, I'm not really a big contemporary fiction, at least that particular genre kind of guy. But great for our listeners to hear. All right, so Nita, we have a new Congress in place. I think many of us were surprised to see that the Democrats now control the Senate, and the Democrats control both chambers in Congress, and then obviously the presidency. I had Chairman Camp on the podcast a couple months ago, where we spoke briefly about the Biden tax proposals, and certainly seems now like the opportune time to revisit those, to really understand what potential legislative changes that we could see. Maybe before I kick it over to you, I will note that I think Nita, you and I have waited our entire careers for a major tax reform change, right? We hadn't seen this tax reform. The last tax reform was well before we started practicing tax law. And now all of a sudden we have the prospect of another significant change to our corporate international tax system, which is, exciting and terrifying both in the same breath. But let's start with what some of those Biden tax proposals are. And, knowing that the Trump proposal, where he proposed a 15% corporate rate when he was up for president, that, what Biden has proposed may be a far cry from what actually gets enacted. But I thought we would start with the Biden tax proposals. Can you walk us through some of those key provisions? And I appreciate there are a lot, but we're really going to be focusing on the cross-border aspects, not surprisingly.
So President-elect Biden has proposed a number of business tax provisions as part of his presidential campaign. Many of the proposals are designed to help with U.S. domestic production and manage the amount of offshoring. Some of the proposals of interest to this particular audience is an offshoring penalty surtax of 10%, which we imposed on the proposed higher corporate tax rate of 28%. And Doug will probably talk about whether or not 28% is where we envision the corporate tax rate going. There's also a proposal to double the tax on global low taxed intangible income, known as GILTI. Also eliminating the exception for deemed returns under 10% of a qualified business asset investment, or QBAI, and moving the GILTI determination to a country by country basis instead of a blended average. There also is a proposal to implement stronger and stricter anti-inversion rules under Section 7874. We don't have a lot of specificity with respect to that proposal, but it is noted in the Biden-Harris fact sheet. There's a proposal to deny all deductions and expensing write-offs for moving jobs or productions overseas where such jobs could be offered by American workers. And lastly, there's a proposal to impose a 15% minimum tax on companies' global book tax income. And so those are, the list of corporate tax proposals that have been mentioned by the Biden-Harris campaign, and will likely see some, interest and movement going forward.
Holy cow! There's a lot there. So we're going to unpack many of those here over the course of the next over the podcast. But maybe before we talk about some of those specifics, are we back with this new administration to kind of business as usual? In other words, are we going to get a green book and have kind of this thoughtful document that, us tax nerds can read and think about the policy and those implications? We didn't really see that, right, with the last administration. And I'm curious as to your thoughts, and again, we'll unpack each of these individual provisions, but just from a kind of process perspective, do you see us kind of moving back to where we were before the Trump administration?
Doug, I think it's hard to predict whether or not things will go back to business as usual. And I question what is business as usual in the current environment and going forward. But there could be an interest to put out a green book like we saw from the Obama administration. And what I find interesting with the green books is that they're not only specific to the administration that's currently in the White House, but also future administrations. What we saw back in 2017, while the Tax Cuts and Jobs Act was being developed, even the Republican staffers were looking at prior green books for ideas and proposals, especially when you're trying to pass tax, changes through budget reconciliation and their deficit and monetary constraints around the process, which we'll touch on later. So will we see a green book? I think there's a better chance with this new administration of actually seeing a green book. But given the timing constraints, given that we're still in the middle of a pandemic, given the priorities of the administration, I don't know if the green book is on the list of things that are going to come out immediately after the change in control, or during this particular calendar year.
Mm-hmm. Well, time will tell. So let's in on some of those specific provisions, but before we even get to likelihood of passing, just to to help shape the discussion. So the first one is let's start with the rate, moving the rate up to 28%. And then there was also a provision along those rate lines to double the rate on. So I think that technically it would move the 50% section 250 deduction to 25%, so that the idea was the rate on the corporate rate would be 28%, and then the GILTI rate would be 21%. I know there have been some Democratic members that have already stated publicly that wouldn't be supportive of a 28% rate. I think even one of them may have said 25. What are your views on the rate, and is 28% likely, or do we end up seeing some sort of compromise? Because I remember the Trump proposal had said 15%, and it felt like the 20% was a compromise to that initial proposal. But what are your views on potential corporate rate change and the GILTI rate change?
I think changes to rates are easy starting point for the discussion. I mean, these are levers that can be pulled. They're estimates that can be provided depending on where the rate goes. So I'm not surprised that companies are already discussing what potential rate increase is possible in the future. 28% rate increase, that's going to be hard for members to digest. Even certain Democrat members, as you noted, Doug, have already said 28% is way too high. With any increase in the corporate tax rate, you have discussions regarding companies moving offshore, re-domiciliations, foreign acquisitions are discussed, and that is counter to some of the policy and the consideration of the Biden or forthcoming Biden administration as well. And so I personally don't see a 28% tax rate increase in the near future. Do I anticipate some corporate tax rate increase? I do. Where that goes is going to be 25%. Will it be 23%? I think it depends on, what are the priorities of the Democrats, what they need funding for, and also what other changes are going to be made to the corporate tax framework. You mentioned changes to GILTI. There could be a change to the GILTI rate deduction. Also, the removal of QBAI. Already, we read in the tax press, we hear discussions about the QBAI provision providing some incentives that don't fall in line with not only the future Biden administration, but also some of the policy considerations of the Trump administration. And so question whether if QBAI is removed, what does that mean to the GILTI rate? Instead of completely removing the Section 250 deduction, does something else happen? Of course, whenever there's a discussion about changes to QBAI, it not only impacts GILTI, but it also impacts FDII. And so those are questions that and policy considerations that could also impact where the corporate rate goes. So that's a long-winded way of saying I don't think it's going to be 28%, but any increase is also going to be dependent on what other changes to the international tax framework occur that can be viewed as pay-fors in keeping the rate low. And all of this too depends on whether or not the Democrats are seeking to find revenue for other priorities, and where the deficit spending falls in line of a very long list of priorities of the forthcoming administration and Democratic controlled Congress.
Yeah, to add a little bit of color to your QBAI comment, I think what some have argued that allowing a U.S. multinational to reduce its FDI or to reduce its GILTI by QBAI is that it arguably encourages investment in those type of depreciable assets offshore. But as you noted, what's interesting, that Section 250 deduction and that same general architecture also applies to foreign derived intangible income that's earned in the U.S. And obviously, from a policy perspective, certainly the Trump administration wanted to increase investment in the U.S. So whether those can somehow be decoupled or we will be very interesting. I think the other point that I would note with respect to GILTI is the proposal to move it to a country by country analysis. And what I think is very interesting, Nita, about eliminating QBAI as well as the potential country by country for GILTI is that would be very consistent with what we've seen so far with the OECD's BEPS 2.0, as it is sometimes referred, and specifically Pillar 2. And so it's interesting that would be kind of very consistent, at least with where those proposals are today. Obviously, that is a moving target. But any thoughts on kind of, particularly the tax policy and what the OECD framework, and whether the Biden administration may be more focused on the OECD proposals compared to maybe the prior administration?
Um, so moving GILTI to a country by country determination is a very heavy lift. And Doug, in my view, part of the reason why TCJA and the changes to the international tax framework were actually enacted and found support was it did simplify the determination of GILTI, which is rather harsh, by allowing aggregation. And once you make the determination on a country by country basis, you sort of take away the compromise that companies were willing and constituents were willing to endure GILTI so long as it was on an aggregate basis. That being said, there's pressure from both the tax writing committees on the Hill as well as Treasury to have GILTI qualify for an exception under Pillar 2. And as we see from the OECD, their GILTI-like proposal, minimum tax proposal, is proposed to apply on a country-by-country basis. And so there's this, delicate dance that Treasury and the tax writing committees as well, they're staying on top of the developments of the OECD. They're having to say, okay, well, if GILTI in its current state won't qualify for an exception, what can we do? And it's not only what can we do in line with the policies of the current administration or the forthcoming administration, but it's also what can we do to make sure that our provision qualifies for an exception. And so there's chatter about, well, maybe utilizing the high tax exception, which Treasury provided regs in order to apply this exception on an elective basis. If there's something that could be utilized with that particular regulatory framework in order to make GILTI in its current state qualify for an exception or just qualify under Pillar 2. I think it's definitely something that's top of mind. And stepping back a bit, the 2017, changes to the law, some of which are very novel. GILTI beat, they were not enacted before. You have the OECD that looked to the US framework in order to develop their Pillar 2 proposals. And what we're seeing with the benefit of time is also ways in which GILTI isn't working. And there's certain proposals, exceptions under Pillar 2 that is shedding light on maybe some things that should be changed legislatively or, if possible, by regs to our GILTI regime. And so I think it's not just trying to see whether our GILTI in its current state can qualify under Pillar 2, but maybe what changes could prove helpful both from, an economic perspective and from a business perspective going forward. So there's all these considerations, Doug, but, at the end of the day, I would find it very difficult to apply GILTI on a country by country basis, and find support for that, from the business community and even from some of the Democratic members and more conservative, with a more conservative constituent base.
Yeah, there doesn't seem to be a lot of sympathy from policymakers related to compliance complexity as some of these rules have gotten enacted. And I think about, a US multinational that operates in dozens of different countries. I mean, that's a separate 1118. That's a separate foreign tax credit basket, right, for every single jurisdiction. And it just makes my brain hurt thinking about applying expense apportionment across dozens and dozens of different baskets. And just from a compliance perspective, the other comment that I wanted to make was you had mentioned kind of GILTI and BEAT being novel. Well, we also have some novel proposals from the Biden administration, right? Which is this 15% minimum book tax. And it's just like, okay, well, what really does book tax income mean? I mean, that seems like, a very, difficult thing to chase, and given different industries have different margin. I mean, just that seems like really challenging. There was also the surtax that you had mentioned on offshore manufacturing and services to put companies what they said at an effective rate of 30.8% for those activities, and then a 10% made in America tax credit. Well, what's interesting me, Nita, about those last two is like, well, if they're trying to encourage investment in the US and prevent offshoring, do we really need new provisions? Don't we have existing kind of levers and dials within the particular system, within the existing system, particularly FDII, Subpart F largely, as well as GILTI? I question: do we really, do we need more new novel tax concepts that really haven't been tested globally whatsoever?
Right, Doug. I mean, those are the exact questions to ask, and those are the exact things that companies and their advisors need to educate the administration, the tax writing committees, and Treasury about. Um, a fact sheet is just a sheet, and with bullet points, they're concepts that need to be developed. As we say, the devil's in the details, and I'm not surprised to see very high level proposals, some of which are, so vague that they can't even be estimated without further detail. But this is exactly what companies should be doing, especially, in the next 6 to 12 months, educating the administration and the tax writing staff about how new rules that are complicated don't necessarily result in good policy. Whether there's a desire to change TCJA because the Democrats were not part of the discussions, or whether there's something that can be tailored within the current framework to achieve some of the objectives that the next administration, or the Biden administration is trying to achieve. And so it's not surprising to see a lot of high level concepts at this period, or during the campaign season. But as details come out, this is where it's really important to stay engaged, talk to the tax writing committees about potential changes. And one example, Doug, I think that we shows that it is helpful to talk to Congress about what companies are facing right before the holidays. I think it was mid-December. We saw some bipartisan legislation from the House with respect to the BEAT that would basically, turn off the BEAT for taxable years ending 2020. And I find comfort in anything that's bipartisan these days. And also the fact that, it took companies going into the House in saying, look, the BEAT wasn't addressed during the CARES Act. It is problematic during an economic downturn, and we think some relief needs to be provided. Now, a 1 year moratorium is probably not enough, and we can discuss this in more detail about the future state of BEAT. But I do think it's a sign where if companies go in and educate the tax writing committees and just members of Congress, even if they're not a member of one of the tax writing committees, about how these rules are working in practice, not only from an economic perspective, but Doug, to your point, from a compliance perspective too. There are people who are willing to listen and they are interested in actually trying to help. And so where this proposal goes, we don't know. It's just a proposal. It wasn't enacted at the end of the 2020 calendar year, but I do find it comforting to see some bipartisan legislation on the international tax front.
Totally agree. And for Beat, to remind our listeners, I think there's been a number of challenges with the practical application of the Beat provision as it was enacted. But I think, overwhelmingly, there are a number of U.S. multinationals that I would argue have been disproportionately impacted by Beat just based on their business models, where we know that it was really intended, it was in the inbound provision, it was really intended to prevent kind of base eroding payments for a foreign non-U.S. parented structure. And so trying to get that fixed or even eliminated, I think certainly makes sense. And I even further agree that, man, I really hope that we can have some bipartisan support for our next major tax policy changes to the extent that those do happen. And hopefully that is the path going forward. And I agree that that proposal in December hopefully is a harbinger of things to come, although there has certainly been a lot of current events that have happened between then and now that could impact that. So let's kind of go along those lines, Nita, on, what is the likelihood of any of this really passing, and remind listeners about the budget reconciliation process. But before I pass it over to you, we'll remind folks that the Democrats have, first of all, a very, very, very tight, the thinnest of majorities in the Senate, right? With 50-50, with Vice President Harris casting the deciding vote. So, there's only so much progressivity that the Democrats could put forth, knowing that they only have 50 votes, and there are a number of members in the Senate that are from relatively conservative districts. The other thing to keep in mind is that, right, there will be midterms in 2 years that could change, obviously, the Democrats' existing position. So it seems that there's a pretty tight window to be able to, if the Biden administration wants to get tax changes through, is that really likely to happen this first year, because they wouldn't want to have that type of vote in an election cycle year. But what are your views and thoughts? And I will also remind folks that you and I are both practicing tax lawyers, tax advisors, and so not necessarily policy specialists, but it doesn't prevent us from prognosticating. So, Nita, what are your thoughts?
No, and I think these questions are on top of mind of all advisors, anyone who's interested in tax, and so I believe, in addition to the tight time frame, the um, slimmest of majorities, there's also a long list of priorities that the Democrats have pulled together, and once again, we're in the middle of a pandemic. And so the likelihood of comprehensive international tax reform, I just don't see occurring, you know, in 2021, retroactive to the beginning of this particular calendar year. There's just too many things going on. And I, believe in my heart of hearts that pandemic relief is going to be the first, priority of the administration. And we saw on January the 11th already, the House Ways and Means has put out a proposal dealing with, healthcare and taxes related to inequities in healthcare. And so I just don't see international tax reform being the first thing that the Democrats are going to focus on right out of the gates. Um, that being said, given the timing constraints and given the fact that there is an opportunity to have, two budgets proposed during the 2021 calendar year. I'm not going to get into the weeds about budget reconciliation, but similar to 2017, there's a possibility of having, a budget proposed dealing with pandemic relief and whatever other types of revenue that's needed to achieve some of the objectives of the Democrats. And then later on, because the government's on a fiscal year that ends September 30th, there's an opportunity to pass another budget that could be utilized for the reconciliation process that could result in some of the changes that are proposed in the Biden-Harris fact sheet. And the budget reconciliation process, just to remind everyone, I know 2017 seems a long time ago, is allows certain legislation to be passed without a supermajority. So instead of needing 60 senators to agree to a comprehensive, change in law, you could utilize the budget reconciliation process and pass legislation with just a simple majority. And this would require, though, all of the 50 Democrat senators, along with Vice President Harris, to vote for a bill under the reconciliation process. And there's also limitations on what can be passed under reconciliation. It has to be revenue specific. You also cannot provide or enact any provisions that result in a deficit increase outside of the 10-year budget window. And that's where we see, at least with respect to the 2017 Tax Cuts and Jobs Act, some quirks with changes to the GILTI rate, to the FDII rate, or deduction rather, and increase to the BEAT rate that's occurring in 2026. That's because TCJA was, enacted under the reconciliation process. And I should note, because of some of the oddities associated with the reconciliation process, it's also why we, call what is Public Law 117-97 TCJA in practice, but in in actuality, it's not called the Tax Cuts and Jobs Act because the title of the 2017 tax reform bill was changed because of the Byrd rule and the fact that it was enacted under the reconciliation process. And so there's, not only the quirks of the Byrd rule, but also the, budgetary restraints that have to be, you know, noted and adhered to if legislation is going to be passed under the reconciliation process. And while it's a powerful tool, there are limitations. And so in my mind, I could see it being utilized, but for any of the international tax changes that we've discussed, I believe it's going to be towards the middle or latter half of the calendar year, not anything that we'll see in Q1 or Q2.
Yeah, I'm with you on that, Nita, and I think particularly some of the novel provisions that we mentioned would be just too big of a lift, it would seem, and given the short time frame, and frankly, with the razors and majorities, and I'm sure that the Democrats will be looking for some bipartisan support. So, which makes me believe that those quote unquote easy levers are changing the corporate tax rate and then changing the Section 250 deduction and that GILTI rate and keeping the rest of the architecture. But time will tell for sure. So maybe the last thing that I wanted to get your thoughts on is the regulatory landscape. We could probably dedicate an entire podcast just to this topic, but in the last few minutes here, we've seen, a whole flurry of regulations. I mean, a flurry of that, a blizzard, how about, of regulations over the course of the last 3 years. I can't remember what the total page count. I think it was 20,000. I might have that off of total regs that have been out, but it's pages. It's been overwhelming, but necessary in light of the new architecture. And then, I think the Trump administration's Treasury Department also was very focused on, frankly, updating, correcting, changing some regulations, particularly in the international area, to really get those kind of up to date with the existing code. We've seen, if the overall experience has been a blizzard, we've seen a recent flurry of regulations here towards at the end of the Trump administration, particularly what we've talked about here in the cross-border tax talks, the foreign tax credit regulations, and even more proposed regs. What's your view on the regulatory environment? Are those regulations that were recently passed at risk of getting pulled? What's your views on what I think is largely a misconception of Democrats, that many of these regulations, I know the high tax exception has been one of those, that these are corporate giveaways, and I think any of us in the industry are like, that's not exactly how these rules work in practicality. But what's your view on the general views on the regulatory landscape?
Well, Doug, I believe that Treasury has been working very hard since 2017, and they have put out very thoughtful, technical regulations in order to help administer what was enacted back in 2017. And, unfortunately, there's still work left to do. And I do believe, to the extent that they're TCJA or non-TCJA related regulations that are not released before January 20th, where we have the transfer of power, those regs are likely going to be pulled and reviewed before being cleared. And that's just the way, the regulatory process goes. And so, to the extent there are regulations that are looming in the space where they've been reviewed, but they haven't been cleared, if they don't get cleared by the 20th of January, I foresee, a slight pause and a review of whatever's in the queue. There's also priorities with respect to certain rules like 864F, which went into effect at the beginning of this calendar year, 1/1/2021. Those, that particular provision will require regulations, and that's at the top of the priority of Treasury as well. And so there's a lot of work that has been done. There's work that will need to be done, and then you wonder whether some of the regulations that were pulled for consideration, I think about the 385 regulations that were issued under the Obama administration that were reviewed and considered under the Trump administration, whether there'll be, changes or an evolution of those regs under the Biden administration. And so there are different lots of regulations. In addition to all of the work that Treasury's been doing on the 2017 Act and regs associated with that, there's also all of the OECD work as well. And so I think it's a long-winded way of saying Treasury's done a lot. Their work is not, done. And it will be interesting to see whether there's a freeze or, whether it's just a pause and then, also movement on what regs have been issued and what regs have already been developed but need to be cleared.
Yeah, this is going to be fascinating to see how the new administration reacts to a lot of those regulations and then the process as you mentioned it. All right, so Nita, we had talked about, and you had mentioned, I want to remind our listeners that how important it is for constituents, taxpayers to get involved in the process, and just wanted to mention that in closing. But because I think you did a really nice job articulating kind of why that is important, particularly early in this year to talk to staffers and to their members about what some of these changes, particularly some of these novel concepts that maybe haven't been fully baked, about what the consequences of enactment might be to certain taxpayers in that position. But maybe I want to end with predictions. What is your view, and what is your view, Nita, on what's going to happen this year? Predictions from corporate and international tax changes by the end of 2021.
Um, Boy, it's a good thing I'm not a betting gal, because I feel like if I had to predict and put money on it, I'd surely lose it. But I believe that we could see a slight increase to the corporate tax rate, um, unlikely retroactive to the beginning of the 2021 calendar year, but a prospective corporate rate increase. I wouldn't be surprised if we also see changes to GILTI from a rate perspective. Whether or not we'll see an elimination of QBAI is still open in my mind, because I think not only does that impact GILTI, it also impacts FDII, which the Biden-Harris fact sheet's silent about. So if I had to predict anything, it would be a slight increase of the corporate tax rate, maybe some sort of tempering of the Section 250 deduction. And unfortunately, I don't anticipate a comprehensive change to the beat, but I could be proved wrong.
All right. Well, we are very aligned. So with that, Nita, thank you very much. Always great talking to you and getting some of your inside the beltway insights. Thank you.
Thanks for having me.
All right. Well, thanks for tuning in to this week's episode of Cross Border Tax Talks. Thanks again to Nita Asher, International Tax Partner in PwC's Washington National Tax Services Group. I'm Doug McHoney, PwC's International Tax Services Leader in the U.S. Stay tuned in 2 weeks for another exciting edition of the Cross Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.